Let's do it. So,
Hi all, I'm Sham. I have Kishan with me.
hi, Sham.
Welcome to this week's Free Float. Today we are going to be giving you guys a kind of top level overview of the ETF market in the US. As Indian investors, ETFs are kind of like a joke here. There's hardly any liquidity, and while you have 50 different Nifty 50 ETFs, outside of that, there's hardly any sort of participation, any sort of index following going on. It's very much a new concept for India, but the US has a very vibrant and huge ETF market. So thought for investors who are looking to invest in US ETFs, we needed like a handy sort of leaflet, right? Saying, okay, these are the players, this is how the market is, and a brief sort of history lesson as to why it has evolved the way it has evolved. So first things first, let's look at the tax treatment for ETFs in the US. Kishan, do you want to throw some light on that?
Yeah, so I think I'll just start by saying that first of all, starting an ETF in India, starting an ETF in US is like so different because like I was just talking to somebody a couple of days ago, and I said like our initial aim with say freeflow.us is to maybe become a firm in the US. I mean, is to be registered in the US and offer like investment services directly. And the first thing they told me was that this would be a good ETF product, and the fact that you can even think about like a startup can even think about rolling out its own ETF program, while in India that's the ultimate aim. Like people like firms like Zerodha and stuff, which is extremely successful. They have to wait for 2 years, to get rid of paper, to get rid of the process. I mean, a firm like Zerodha, they have to wait for 2 years to launch an ETF or to launch a mutual fund, where there's no real difference in the regulatory process of the two. And that is always, I mean, what that does is that it, there's a concept called regulatory capture, and regulatory capture is basically that the current regulations favor the incumbents. So in India it favors the likes of the big boys, like Franklin and Aditya Birla and like Edelweiss and Kotak and I mean all the big boys, so that there's really no competition because all of them have the same funds. I mean there's no real difference in the funds that they manage, and that fund and that folk that they manage. I mean the funds that they manage, like all the large caps. Everyone has a large cap, everyone has a small cap, everyone has a I mean. Right, some bond fund, like no one really that no one sells it, understands the risk underneath it, so there's no real innovation. While in the US, we have spoken about this before, where you see like ETFs that invest in funds that are researching psychedelics, not investing in drug psychedelics, but investing in companies that are trying to use psychedelics to treat like mental illness and stuff like that. So just the fact gives people innovation. So you have first companies that are doing that kind of research, so you can invest in those companies. So that's like a very innovative economy, but also it allows an average consumer or an average person to invest in these funds or to invest in new technology, which gives them, if it works out, gives them a better chance in earning a higher than average market return. So I think that's the first major differentiation.
Right, absolutely. So one thing that strikes me in India is that you mentioned regulatory capture, right? And it's not just at the mutual fund level, it's at every level, except the brokerage area. So it's easy to become a broker, right? And the reason why it's easy to become a broker is, stock exchanges, wrote most of the rules and regulations and the entry criteria for becoming a broker. Whereas in everything else, SEBI, did some consultation with I don't know who, and came up with all these nonsensical requirements like, RIA should have a net worth of some shit. ETFs and mutual funds are bundled together under one license. So without a mutual fund license, you cannot really launch ETFs. And once you meet the criteria for becoming a fund manager, right? Your cost structure is already so big that you can't break even with just ETFs and direct plans. You need that sales force, you need that distribution network to actually break even as a business. So, and then you have these PMS, characters who have again raised the requirements both from a client perspective as well as from a manager's point of view. So, PMS continues to be a shitty product that doesn't scale, and but still, you have all these barriers to entry that keeps away new entrants who may have a better way of slicing the same slicing the same potato and make some money out of it. But no, so what we have is all these old tatas who are sitting there on piles of AUM, who are preventing maybe niftier entrants who can come in and make a difference. And what that has led is basically zero innovation on the asset management front in India. But US is a stark opposite. I would say that there's a bit too much innovation on the ETF space. You have all these like the post sort of touches upon the inverse ETFs and the levered ETFs and so on. So that's something that we should discuss some point in the future. So I think there's too much innovation, but at the same time, the barriers to entry are pretty low. If you can manage your costs, your break-even levels are much lower. And there are ETF issuers who are based out of all over the world. It's not just US. So there are guys sitting in Australia managing ETFs in the US. So it is possible.
Yeah, and the thing is, you have two, and you're very spectrum, right? You on one side you have Vanguard and BlackRock, who become these passive investment like powerhouses, while on the other side you have like ARK, which is in the last 1 year or so, it's gone from being like a very small fund manager to like everyone talking about it, like everyone like I've seen people on like Indian investment groups share presentations by ARK, like
ARK is largely bullshit, right? So I'm not a big fan of but I agree with your broad thrust of the
it's like a become a thing for active investing, and we might think that the investment product itself is like has flawed and is done well because the stocks, some of the stocks they're holding has gone up, but it's something that you have to admire from a level that it's possible for someone to just start a fund with like 3 or 5 year record, and it's not a fund that's like a hedge fund which is limited to a few participants. This is anyone can invest in these funds, like me and you can invest in here, and you can invest as little as $5,000 or so, and you still get access to these ETFs, which is pretty great,
Right. So the ETF industry itself is kind of like an accident, I feel. So for the longest time, ETFs existed in sort of like a regulatory, what should I say, gray area. The thing is, in the US, mutual funds are not passed through like in India. So in India, if a mutual funds, keeps trading and accumulates profits, those profits are not taxed. You as a mutual fund investor, you are taxed only when you sell the units. Whereas in the US, say you bought Microsoft at 10 and you sold it at 20, that $10 differential is taxed. So what happens is, at the individual level. So what happens is, say a mutual fund, undergoes a panic sort of redemption process, then they have to like sell all the profitable positions, and you end up with a taxable event, especially when the market has tanked. So mutual funds there kind of were initially boxing with one hand tied behind their backs when it came to competing with the index funds and ETFs. So what ETFs had was they took this tax advantage and ran with it, right? So they took this tax advantage and kept, sort of repeatedly telling people that if you're a new investor and you're investing from, and you're not investing from a 401k or a IRA or whatever, which is tax advantaged, then it doesn't make sense for you to buy a regular mutual fund, right? First of all, they're not beating their benchmarks, and second of all, you have this tax problem. So just buy an ETF and you manage your, whatever alpha you want, you use ETFs to get that. So that has, led to sort of like a, Cambrian explosion, right? So you name a segment and there is an ETF for it. So in fact, if you actually look at the sub-segments and all that, pretty much every geographical area, right? Every sort of commodity, like there's a uranium ETF, there's a lithium ETF. Every sort of factor. So you want, emerging market momentum. Yeah, there it is. You want to mix value and, quality. Okay, there's an ETF for that. So basically, there is an ETF for that. Has become like a catchphrase, right? You name it, there's an ETF for that. So it's a very fascinating market because compared to what we have in India, the kind of the range of choices you have there is humongous, and along with the choice comes responsibility, right? So most people get carried away when they look at all these different things. You mentioned ARK, and ARK is no different from some of these small cap managers who loaded up on illiquid shitty names during the previous upcycle in small caps. And what happened? Everybody knows what happened to those funds. They were the only buyer in the market. So when they started selling, the difference between their mark to market and the actual sale price was humongous, because there was no buyer at those at those prices in the first place outside of themselves. So the same thing could happen with ARK and a bunch of other ETFs that seem to have caught investor fancy. They are becoming bigger and bigger proportion of the float, and there is a sort of Lakshman Rekha that you cross, when you become too big for the market, and when redemptions hit, it is difficult to sort of say that mark to market will actually be anywhere close to your redemption price. So you may take a bigger haircut than you thought you would be taking. So these are all what I would call actively managed ETFs. So ARK is an actively managed ETF. It is something that is new, actually. The whole category is kind of new because mutual fund guys, the old school guys, until recently they had a fairly big chunk of assets, and and the larger you are, the more powerful you are. So they were blocking regulation which said that you can actually give actively managed ETFs. And they were like, no, ETFs should always, have an index and it should just follow that. How can you allow it to be a tax advantaged version of a mutual fund? But thankfully, under Trump, SEC did not listen to that, and they kind of said, okay, let's go. Actively managed ETFs are the same as regularly managed ETF. So now if you see, ARK doesn't really have an index, right? So there is no index provider for ARK. They do their own thing, but that is new. So until very recently, you needed an index provider. So even if you had a fancy model with which to manage funds, you still needed to find an index provider who will take that model and construct an index for you. And it had to be like arm's length, right? So you can't own that index provider. That guy needed to be independent.
And that's for your benchmark.
Yeah, not just for your benchmark. So for example, if you buy the most popular momentum ETF in the US, right, MTUM. So MTUM follows the MSCI US Momentum Index, right? And that MSCI Momentum Index is something that is constructed by MSCI. But what if we had a different way of doing momentum with US stocks? Then, like MSCI, you had to find an independent provider. And there are a bunch of them. And you go and tell them that, look, here's my model, now construct an index. So once that guy constructs an index, you license it from him, and you launch your ETF. So there were all these sort of nuances. And if you look at the index providers themselves, right? So they have beaten the shit out of S&P 500, the rest of the market. So MSCI and S&P Global Indices, two of the biggest index providers, their stock is off the charts because they're like the gatekeepers. They were like the gatekeepers, right? So if you want to launch an ETF, you had to go and give them a bunch of money to license their index. But thankfully, with this actively managed stuff, you don't need it. But you still need a benchmark. So which is a different issue. So like this, what's fascinating is the whole series of levered ETFs. So they give you like 2x or 3x the daily return of a specific benchmark. So it's something that some Indian investors have asked before, like why can't we just buy this? 1x Nasdaq sounds fancy, but the thing is, or like 2x or 3x Nasdaq sounds fancy, but the thing is, it's a daily rebalance, right? So they buy futures and they rebalance daily. So it is not what you expect them to be. So read the prospectus, understand how those funds are managed before you jump into any of those. And thirdly, there are many areas, right? So like there's that are like kind of there because they've caught the buzz. So these ETFs are fairly short-lived, right? They are not going to be around for a very long time, because as soon as the buzz dies down, the AUM drops, and and you no longer sort of have the AUM required to break even, so they just shut down the ETF. So it's just like any startup in some sense. So there was this ETF called a cyber security ETF. I forgot what it was called, which got into all sorts of trouble with with the way it was structured, and the founder basically lost the rights to his own ETF. So there are things like this that keep happening, and you need to be careful before you jump to do any of these niche ETFs. But the best part is, if you're just going to invest in the S&P 500 or the Nasdaq 100 or whatever, those ETFs are available for 3 beeps, right? Yeah. Whereas in India, that S&P 500 index fund will cost you 50 beeps. Right, so it's a big difference that accumulates over a period of time. You will not immediately see the difference, but over a period of time, these things add up. And if you're investing for a long enough time frame, you need to keep that in mind as well. But it's a fascinating thing. So I don't know, like, was Vanguard always in ETFs, or were they caught kicking in skimming?
It is first in the mutual funds.
Yeah, so I remember reading somewhere that Bogle was not a big fan of ETFs. Yeah, so he was like ETFs just encourage trading. So he was like, let's do index funds and make sure that people forget about it, right? So that was his thing. So I think Vanguard was a later entrant.
And I think there's still some fears about ETFs being like them being a market risk. Like the market, because of in very turbulent markets you could have ETFs not being liquid.
Right.
Or the fact that ETFs can fall faster than then they can sell positions. So you have still, I think, some unresolved or unknown because this is some question marks there, that
Yeah, I think we saw some of that surface, in March 2020. So there were a couple of bond ETFs that faced this liquidity crunch. And during a sell-off, the problem with bonds is, you still need to pick up the phone and call someone to trade it. So,
and liquidity dries up. I mean, the spreads become wide, and the liquidity really dries up. You saw that happen in India, and it happened in the US, where spreads really widened quite a lot.
Yeah. So the thing is, this sort of risk is always there, liquidity mismatch, when your wrapper is supposed to be extremely liquid, but your underlying is illiquid, right? So, it's all fine and dandy with just market cap ETFs, because at the end of the day, it just reflects the market cap of the underlying. They don't have to do anything special. But the minute you venture out of this market cap plain vanilla ETFs, equity ETFs, and you venture into bonds, or even like equal weighted ETFs, or any of the other fancy stuff, you end up with bigger problems where, related to liquidity. So more than expense ratio, I think people should look into these things. Make sure how to Google them and how to read the docs before getting into anything.
Because how funds, unless such situations, I think, would vary, and there's a lot of things. There'll be a lot like in the fine print. I think we should we should cover that at some point. What happened, what happens when things go bad, and how do ETFs plan to handle those situations?
Yeah, absolutely. I think we should look at some of the ETFs that exploded badly. So there was this volatility ETF, and
which went short.
Short volatility ETF. The funny thing is, if you had actually implemented it with options, you would have probably made money. But if you bought that ETF, then you lost all your money. So,
and then you have an ETF that invested in gold, which went bust.
Oh, really?
Went negative. Yeah.
Okay.
Yeah, and not gold. Sorry, oil.
Oh yeah.
Yeah. Because it basically bought. It basically sold the contracts on expiry and bought the next month contract. So when oil went negative, it went bust.
Yeah. Roll risk, man. Everybody piling into commodities these days, and none of them are, I wouldn't say none, but most of them don't appreciate this roll risk.
Again, it's a very detail. It's lost in the details.
It's lost in the details, and frankly, the thing is, it's one thing if these investors, when it does go bust, they just like lick their wounds and carry on, but they don't do that. They'll go sue, and and they will say, no, nobody warned me about this. I was missold, I was this, I was that, and try and get some compensation going from whoever is ready to pay. So I feel most of these things, if you're entered into these things, contracts, without reading anything and without doing any research, then you really had nobody else to blame but yourself, right? It's the ultimate thing. Like, the docs are available publicly, there are people who have commented upon it. It's nothing new. This role risk has been going on since the last 10 years. People have written pages and pages on it. So even after all that, if you don't do your research and you just do buy into this, then it's really on you, right? So I don't know what more can be said about that. And the thing is, the final driver of all these products is competition. So as fees went down in your plain vanilla products, they were forced to sort of look for greener pastures, and they will keep coming up with newer and newer products. That's their job. And it just like how it is your job to kind of read what it is and understand what you're buying. And it takes two to make a market, right? So there are a lot of ETFs that don't see the light of the day because investors kind of shit all over it and say, no, this is a very bad idea, and they shut shop. So it's not like every ETF is going to be successful, and at the same time, choice brings with it responsibility. So anyway, I think when it comes to US investors, Indian investors investing in the US, I think the first thing is to do like a cost benefit analysis, because we've spoken about this before. Like FX transfers itself is like a 3% hit. It's not just the fees, right? The rate you get is also at your disadvantage. So you cross the bid offer and you pay the fees and you pay the GST on the fees. So all in cost of moving money from here to US is around 3%. So once you move there, it is treated as how a bond investment in India is treated, right? So if you sell before 3 years, it's added to your income. So if you have a 30% income slab, you need to incorporate that, versus in India where you hold it for a year and you pay only 10%, right? So there's a break even for this. And in India you have STT, whereas in the US you don't. So this STT makes a lot of difference if you're in a strategy that requires a lot of churn. So if you're doing any sort of Momo strategy, right, you're better off doing it in the US. Assuming that the returns are similar, right? If so, you do your high turnover strategies in the US. You're better off paying that 30% tax on your overall investment rather than paying this STT on each trade. So there's a break even for all of this, and I think it's worthwhile going through that exercise with the spreadsheet with with our viewers. That's something that we should do in the next free float.
All right. Okay.
So until next week, see ya.